Hello class, it's Patrick. I am blowing up our chapter 2 screen here. Just bear with me for a second. Alright, so as I mentioned in the first class, finance is really a blend of accounting and economics. And these next two chapters are really going to detail probably and review some of the things that you learned in accounting. But there may be a few things that are new. So the chapter really begins by discussing, or at least used to begin by discussing, company write-offs. The old text had another example on how home builders' land values had declined during the recession, and home builders wrote it off. And the point was that stockholders most likely didn't lose, a lot of money because of that. And the question really was why. And cash flows really hold the answer, which is really what we're going to dig into here in Chapter 2. So just to start out by reviewing some of the concepts and skills we're going to want to know from this chapter, we're really going to want to know the difference between book value and market value. We're going to want to cover the difference between accounting income and cash flow. We want to know the difference between average and marginal tax rates, and finally how to determine a firm's cash flow from its financial statements. The outline looks as follows, where we will begin with the balance sheet. We'll go into the income statement, talk a little bit about taxes, and then we'll get into the statement of cash flows. So I can say this much. 2.1 and 2.2 should be very familiar to what you've already covered in accounting. 2.3 and 2.4 might have some new elements to them. Okay, so let's start out with the balance sheet. As you probably know at this point, the balance sheet is known as a snapshot of the firm's assets and liabilities at a given point in time. It's really a convenient way of organizing information. On the left-hand side, you have your assets. You consider this upper portion, and it's in order of decreasing liquidity. And one way of thinking of assets is what a firm owns, whereas liabilities and owner's equity is what a firm owes. So this is the right-hand side or the lower portion, and it's in ascending order of when it's due to be paid. The balance sheet identity is assets are equal to liabilities plus stockholders' equity. So it's good to know the kind of the identity there and the differences and how you can kind of change them around algebraically in order to solve for another variable. In terms of the balance sheet, as you can see here, you have your total value of assets on the left-hand side and the total value of liabilities and shareholders' equity on the right-hand side. Current assets are assets with a life less than 1 year. Fixed assets have a longer life. There's tangible and intangible fixed assets. Examples of a tangible fixed asset could be something like a truck. An example of an intangible fixed asset could be something like a patent. As far as the liabilities go, current liabilities have a life less than 1 year. An example there could be accounts payable. You also have your long-term debt, which is debt that is not due in the coming year. And then you have your shareholders' equity, which is, whatever is left over for the firm, that's going to go back to the shareholders. So, all these financial decisions that you're seeing here, you can consider in a sense that you have your left-hand side, which are kind of your investment decisions, the asset decisions. And then on the right-hand side, you have your financing decisions. which kind of relate to your liabilities, your debt, your equity, that sort of thing. As far as the balance sheet goes, you saw it noted on that previous slide here, net working capital. We talked a little bit about this last week. Net working capital is going to be your current assets less your current liabilities. It will usually be positive for a healthy firm. Liquidity is something we're going to have an entire chapter devoted to, but for the sake and purposes of right now, I think it's just best to think of cash. It's the speed and ease of conversion to cash without significant loss in value. It's valuable in avoiding financial distress. Then you have your debt versus your equity. And as I mentioned, the identity that we were talking about earlier with the balance sheet identity um, can be very helpful here. When you're looking at your shareholders' equity, it's assets less liabilities. Um, and in terms of interest and principal payments on debt, they have to be paid out before cash can go back to those stockholders. So that's something that you should note. I don't know if the text still has this exact example, and I'm sure if it does, it's been updated. But this is the old example that the old text used to have with a simplified balance sheet for this figurative U.S. corporation. Um, we'll take a look later at more complex statements, but the basic point of kind of introducing this is just to make sure that the student at this point is familiar with this sort of structure. Of course, assets on the left-hand side, liabilities and owner's equity, and then your retained earnings. I know for sure you guys are because you just got out of accounting. So we're going to move on, but the main purpose here is just to make sure that you're familiar with a typical balance sheet. One thing we want to discuss a little bit is the distinction between market and book value, and I think this is, as far as this class goes, and these chapters go, this is an important concept that is definitely something that you need to keep in mind. Book value is the balance sheet value of the assets, liabilities, or equity. Market value is the true value, the price at which the assets, liabilities, or equity could actually be bought or sold. And the truth is, market value and book value are different. So a good question is why are market value and book value different, or could they be different? A good point here is that total assets on the balance sheet is often not a good estimate of what assets are actually worth in the real world. And that's really it. I mean, the market is different than book value. Book value tends to be the accounting value at which something was bought or sold. The market value is what it could be bought or sold right now in market terms. So which is more important for decision-making purposes or for the decision-making process? Of course, the answer there is going to be market value. The best estimate of market value will be the market value of liabilities and the market value of equity. So at one point, again, this is I hope this is current in your current textbook. There was an example, 2.2 on Klingon Corporation. And here you can see there's a balance sheet noting the distinctions between the market value and the book value for assets, net fixed assets, long-term debt, and equity. And there's some things that we could talk about in depth as far as this particular example here. You can see that your 500 and your 600 over on the book value are going to sum to 1100 in terms of your book value. In terms of your market value, you can see that the equity in this particular organization is higher for equity, and therefore we sum to 1600. And that's an important distinction. I mean, you can look at it also over on the asset portion, and you can notice that the current assets and the net fixed assets are actually worth more in market terms than they were in the book terms. These are just important concepts to keep in mind because when you're reviewing accounting data, it's important to know that the book value may not be equivalent to the market value. All right, so moving on to the income statement. The income statement measures performance over a specified period of time, whether it's period, quarter, or year. Whereas before we were thinking of the balance sheet as a picture, you can think of the income statement as a video recording. Here we're reporting revenues first, and then we deduct any expenses for the period, and the end result is going to be net income or the bottom line. Dividends are going to be paid to your shareholders. That will also be reported. And of course, you're going to have an addition to retained earnings, which your net income less your dividends will be your retained earnings. So the income statement equation really is going to be your revenues less your expenses. As far as what a income statement typically looks like, this is a pretty good example. You can see here you have your kind of fixed and variable cost. You get down to your EBIT, which is your earnings before interest and taxes, and you get down eventually to your net income. If you really break this down, you can kind of think of the first three: net sales, cost of goods sales, or cost of goods sold, I should say, and depreciation as kind of investment decisions. And below that, your EBIT, your earnings before interest and taxes, your interest paid, your taxable income and taxes, all kind of financing decisions. So in a sense, you're looking at investments and you're looking at financing again, which is similar to the balance sheet. And that's something to keep in mind moving forward. When looking at the income statement, keep 4 things in mind, and we're going to go through each here. First, the gap matching principle, and I'm assuming you guys have already covered gap in accounting. This recognizes revenue when it's fully earned, not received. I'm pretty sure you probably covered this in pretty good detail in accounting. And here you match expenses required to generate revenue to the period of recognition. A second thing to keep in mind here when looking at an income statement is non-cash items. Here expenses are going to be charged against revenue that do not affect cash flow. So the income statement is going to contain these non-cash items. And depreciation could be considered potentially the most important. It's one of the reasons why net income is not equal to cash flow. As far as the third area of concern here for income statement is time and costs. You have fixed and variable costs. And this is important. I mean, something that was covered in managerial economics was the difference between the short run and the long run. And if you recall what the difference was, it was really a distinction between fixed and variable costs. So again, this is coming back, and it's something to pay attention to in terms of the income statement. So this is not necessarily the time and costs may not be kind of evident in the income statement. And fourth, earnings management. There may be smoothing of earnings, and GAAP leaves some wiggle room. So in some cases, the company may want to show its best to shareholders and therefore use some wiggle room to do so. We're going to kind of skip through this. You may be familiar with the SEC, which is the Securities Exchange Commission. This gives you a link to kind of check that the SEC out and the reports that are published on the SEC. So if you want to get into more detail there, just click that little link down on the right-hand corner of this PowerPoint. The next part of the chapter digs into some tax issues. And really, in some ways it's going to be a little bit of a review because we did discuss some of this when it comes to in managerial economics, we discussed marginal and average tax rates. Um, Marginal is the percentage paid on the next dollar earned. Um, you may remember I really tried to stress marginal being kind of a concept for the next unit. And that's the case here. In this situation, the unit is the dollar. The average is the total tax bill over taxable income. So again, marginal in evaluating cash flows expected from new investment, because cash flows will be taxed in addition to the existing profit, we're going to be using a marginal tax rate. But for average, it's really for purposes of computing companies' total tax liability, and therefore we're going to use the average tax rate. So if we're considering a project that will increase taxable income by $1 million, which tax rate would we use? We would use marginal. Again, we have a little web surfer over here in our right-hand corner, which will take you to the IRS website to give you a little bit more information there. But getting to an example, we'll walk you through a quick example here. Suppose you have a firm that earns $4 million in taxable income. Let's think about what is the terms of tax liability, what is the average tax rate, and what is the marginal tax rate. So let's calculate each of these. Tax liability to start things out. Well, the first thing we would do is we take our $50,000 in taxable income. So we said it was $4 million, right? So of course, that first $50,000 is going to be taxed at a 15% tax rate. Then we're going to add, so it's 50,000 less 0 times 0.15 plus 0.25, second tax rate, 25%, of 75K less 50K, which is going to give you 25K times that 25%. Then you're going to do 34%, which is going to be 100K less 75K times that 34%. Plus, at the 39% tax rate, you're going to be looking at about 100K, about 335K less 100K being multiplied by that 34%. Sorry, 39%. And then finally, the 4 million less the 335K times that 34%, and that'll get you up to $1.36 million in terms of your tax liability. The average tax rate, you would take that 1.36 million over the 4 million, and you get a 34% tax rate. And the marginal tax rate is pretty straightforward in the sense that it's going to be 34% because that's the tax rate that 4 million would fall in. It's between that 335,000 bracket and the 10,000 bracket. By the way, you can click on this little Excel sheet, and hopefully an Excel sheet would open up the lower right-hand corner of this PowerPoint slide, and that'll give you the formulas, which can walk you through everything we just covered in this slide. Okay, so now we're moving beyond taxes, and we're going to move into the concept of cash flow. And really, this is one of the most important pieces of information that can be derived from financial statements, and one of the most important things we're going to really discuss in this class, because we're going to be using it as building block as we move forward. The accounting statement of cash flows does not provide the same information that we are interested in here. Our focus is really going to be on how cash is generated from utilizing assets and how it is paid to those who finance the asset purchase. So we're actually going to cover free cash flow. And we're going to discuss 2 ways to calculate free cash flow. And the truth is, one of the things I typically do at this point in the class is I slowly go through all of the above as far as the formulas go. And I do tell the students that, of course, you're not going to necessarily be responsible for knowing the formulas, but you should have an idea of how these things are calculated. And that's why I like to write the formulas up on the board. And of course, I'm not going to really have the opportunity to do that because we're using slides here. But I do want to just point that out. This formula right here, for example, each of these elements has its own formula. For example, operating cash flow. Operating cash flow equals EBIT, which is your earnings before interest and taxes plus depreciation less taxes. Net capital spending is your ending fixed assets less your beginning fixed assets plus depreciation. And then your change in net working capital is your ending net working capital. What's that mean? Well, your current assets less current liabilities, less your beginning net working capital. Again, current assets and current liabilities at that point. So you can imagine there's a lot of formulas involved here just to get your cash flow from assets, also known as your free cash flow. Alternatively, there's another way to calculate this, and that would be utilizing your cash flow from creditors plus your cash flow from stockholders. The cash flow from creditors is equal to your interest paid less your net new borrowing. But what's net new borrowing? Net new borrowing is your ending long-term debt less your beginning long-term debt. And your cash flow to stockholders is equal to your dividends paid less your net new equity raised. What's your net new equity raised? Well, that's ending common stock, additional paid in capital and treasury stock, less your beginning common stock, additional paid in capital and treasury stock. So, point being, all of these variables have their own equations. So let's take a real quick look at how you could calculate this if you had to. Okay, so we're looking at U.S. corporation here. We have a balance sheet and we have an income statement available to us, and we have all of the formulas that I just mentioned on the previous slide available to us as well. Could we, from that information, get ourselves our cash flow from assets? Yes. Okay, so we'd start with our operating cash flow. We'd find our EBIT. If you refer over to the income statement, you can see that the EBIT is $694. Depreciation $65, and your taxes are $212. You do the math of the equation, and that you get yourself your operating cash flow of $547. Now, let's look at our net capital spending. We need our ending net fixed assets less our beginning net fixed assets plus depreciation. We already know our depreciation is $65. So we need to look at our ending net fixed assets. If we find our ending net fixed assets, that is going to be $1709. And our beginning net fixed assets are going to be $1644. So we do the math there, we get $130 for our net capital spending. Finally, we're looking at our changes in net working capital. We're looking at our ending net working capital, which we take our 1403 less 389, less our beginning net working capital, which is 111 less 428, and from that you're going to get 330. So again, 1403 is you're taking your current assets in 2010, less that 389, which is your current liabilities in 2010, and then your beginning, which is your 1,112 current assets, less your 428 current liabilities, you're going to get 330. So then you plug all those variables into your cash flow from assets formula, which is you're going to take your operating cash flow, which is 547, less the net capital spending, which is 130, less the changes in net working capital, which is $330. You end up with $87 as your cash flow from assets. Alternatively, you could solve for that $87 in another way. So we're going to show you the alternative approach. Here we have our cash flow from creditors and our cash flow from shareholders. So let's start with the cash flow from creditors. We look at our interest paid, which is documented on there on the income statement at $70. And then we'd look at our net new borrowing, which is 454 less 408, and you end up with $24 for your cash flow from creditors. As far as your cash flow from shareholders, you're looking at dividends paid of $103, which is again noted on your income statement. Then you're looking at your 640 less your 600, and you'll end up with $63. 24 plus 63 gives you 87. So either way we approach the cash flow from assets, we could end up with a cash flow from assets. It doesn't matter which approach we utilized, we ended up with the same answer. A lot of the formulas that we discussed are located on this slide, so this slide may be useful going forward. I can tell you we're not going to get into the weeds here again in terms of how to come up with the cash flow, but we will be using cash flow in general as we move forward. In fact, we'll be like forecasting it and whatnot. So it's good to have an idea that the cash flow that we're talking about is not a figurative or theoretical element. It's a literal element that you derive from your existing accounting statements. That is the end of this chapter, and we're going to end here. There are some exercises towards the end, but we're not going to go through them right now. Thanks.